The term emerging markets was coined in 1981 by the International Finance Corporation as a marketing term to help make the case for foreign investors investing in developing economies. Today, emerging markets make up roughly 10 to 12% of the global free float market capitalization, representing around 25 countries including China, Taiwan, India, South Korea, and, until recently, Russia. Characteristics like high economic growth expectations and attractive valuations compel some investors to overweight emerging markets in their portfolios. But there are some often overlooked facts, costs, and risks that should be carefully considered. I'm Ben Felix, Portfolio Manager at PWL Capital. I'm going to tell you about the intricacies of investing in emerging markets. One of the longest running myths in investing is that economic growth and investment returns are positively related. That is, if you invest in the highest growth economies or sectors, you will earn higher investment returns. The reality is the exact opposite. This is documented in detail by Dimson, Marsh, and Staunton in the 2014 Credit Suisse Global Investment Returns Yearbook, where they find a cross-sectional correlation of negative 0.29 between real equity returns and real per capita GDP growth for 21 countries with continuous stock market histories from 1900 to 2013. In a 2012 paper titled Is Economic Growth Good for Investors?, Jay Ritter found similar results for 19 primarily developed markets from 1900 through 2011, with a negative cross-sectional correlation of 0.39. Ritter also looked at a sample of 15 emerging market countries for the 24-year period from 1988 through 2011, including Brazil, Russia, India, and China, and found a similarly negative cross-sectional correlation of negative 0.41. This evidence suggests that countries with stronger economic growth have historically had lower stock market returns. The reasons are probably a combination of expected growth in earnings being priced into high-growth economies, and growing profits in these economies being spread across an increasing number of shares as new businesses emerge to meet the demands of a growing economy. If aggregate earnings grow, but lots of new businesses start or existing businesses raise new equity capital, earnings per share growth, which is what matters for stock returns, will rise less due to earnings being spread across more shares. An interesting laboratory to observe this effect is war-torn and non-war-torn countries from 1900 to 2000, as demonstrated by William Bernstein and Rob Arnott in their 2003 paper, Earnings Growth, the 2% Dilution. Bernstein and Arnott show that while war-torn countries had their economies devastated by war, within little more than a generation, their GDP caught up to or surpassed the GDP of non-war-torn countries. Despite their impressive economic recoveries, war-torn countries' dividend growth trailed their economic growth, measured by per capita GDP, by nearly twice as much as the non-war-torn countries in the sample. The explanation for the larger gap is that war-torn countries had to go through a high rate of equity recapitalization. New companies needed to form and existing companies needed to raise new capital for the economic recovery, diluting the benefits of economic growth for existing shareholders. A nice anecdotal example is China. Despite massive economic growth by any measure that you can think of, the Chinese stock market has delivered substantially lower returns than international developed markets. While expected economic growth may not be a reason to overweight emerging markets, there are some other good arguments. Emerging markets have a much larger economic footprint measured by things like GDP, population, and land mass than their weight in financial market indexes. One of the reasons for this is that index providers typically focus on the investable market from the perspective of a global investor, meaning that foreign ownership restrictions in some countries reduce the size of their investable capital market from the perspective of a foreign investor. China's A shares are a good example. MSCI excluded them until 2018 and even now only allocates 20% of their actual free float capitalization in their indexes. The other big contributor is the use of free float weightings. Free float measures the value of shares that are available for trading, excluding shares owned by, for example, state-owned enterprises and company founders. Typically, free float weights as a percentage of total company capitalization are much higher in developed markets than in emerging markets. There are some other important details to know about how this asset class fits into a portfolio. Emerging market stocks tend to be volatile, but they also tend to have diversification benefits with respect to the developed market portfolio. One of the reasons for this diversification benefit may be incomplete market integration. An integrated market is fully open to foreign investors and for domestic investors to own foreign assets, while a segregated market is completely closed. Think about an investor in a country who cannot invest outside of their own country, and no companies in their country can raise capital from foreign investors. In that case, only local economic risks matter in determining an asset's expected return, and expected returns will tend to be higher since investors are unable to diversify their risk. An investor in a country like Canada, on the other hand, where you can invest globally, will assess expected returns based on the asset's risk contribution to the market portfolio rather than on the local risk factors. In a segregated market, assets will be priced based on local risk factors, and expected returns will tend to be higher, whereas in an integrated market, assets will be priced based on their contribution to the risk of the market portfolio, and expected returns will tend to be lower due to this diversification benefit. Lower expected returns sound bad, but for the real economy of an emerging market, lower expected returns are great. The expected return is the cost of capital that the businesses listed on the stock exchange use to assess projects. A low cost of capital should mean more investment in projects and more economic growth. This is confirmed empirically in the 2000 papers Foreign Speculators in Emerging Equity Markets and Equity Market Liberalization in Emerging Markets. When countries liberalize their financial markets, their expected returns tend to fall and GDP growth tends to increase. The other implication here for investors in emerging markets is that if you are invested before complete integration, you expect to earn a premium as expected returns fall and prices rise as the market liberalizes and integrates. Of course, this premium can't be predicted or timed, and it's definitely not guaranteed. A partially integrated financial market can deliver a diversification benefit and a high expected return. But as emerging markets liberalize and begin to integrate, allowing foreign investors in, their expected returns should fall, or their covariances with the market portfolio should increase as foreign capital absorbs the diversification benefit. An asset with a low covariance with the market and a high expected return would be a free lunch, and its price would quickly be bid up, meaning its expected return would fall to the point that its expected return matches its risk contribution to a diversified portfolio. The extent to which emerging markets are integrated is another important question for investors considering this asset class. Empirically, based on the paper What Segments Equity Markets, emerging markets have become more integrated over time, but are still more segregated than developed markets. This implies an ongoing diversification benefit. Additionally, while correlations between developed and emerging market returns have increased since the 1980s, they have remained imperfect at around 0.8. Emerging markets have another unique property that needs to be considered. Looking only at the mean and variance of an asset's contribution to a portfolio assumes that the returns follow a normal distribution, ignoring an important statistical measure called skewness. Skewness measures the asymmetry of a distribution. Aggregate stock market returns are negatively skewed in general, meaning that returns are generally more positive than negative, but there are infrequent extreme negative returns. Emerging markets exhibit an even more pronounced negative skew than stock markets in general. We can think about this as disaster risk. Similar to volatility, we don't actually care about the skewness of an individual asset on its own. We care about the contribution of the asset's skewness to the skewness of the overall portfolio, a measure called the co-skewness. As it turns out, as documented in drivers of expected returns in international markets, emerging markets have historically had negative co-skewness with the MSCI World portfolio, meaning that adding them to the portfolio makes the overall portfolio skewness more negative. This property, negative co-skewness, should increase the expected return of an asset. Negative skewness is not something that most investors want in their portfolio, so they need a higher expected return to compensate. In conditional skewness in asset pricing tests, we learn that both in the theory and the empirical data, negative co-skewness does in fact command a meaningful risk premium. Maybe this sounds enticing for any risk-seeking investor. Another priced risk. But the type of disaster risk that has historically shown its face in emerging markets might make you think twice. Looking at developed and emerging market portfolios from 1900 through 2020, it may be surprising to see that emerging markets have trailed developed markets for the full period. This underperformance is largely due to a disastrous period from 1945 to 1949. Japan lost 97% and Chinese markets were closed in 1949 following the communist victory. There were other poor performers, but these examples demonstrate the extreme disaster risk. It's easy to brush this off and say that this type of collapse couldn't happen today. But emerging markets generally have greater political risk, less developed stock markets, and tighter control on foreign investors than developed markets do. Disaster risk may be showing up in Russia right now. Russia was previously classified as an emerging market, and at the time of recording has been demoted by index providers to a standalone market, due to its stock market no longer being investable. There is a risk premium for that left tail risk for a reason, but it's important to realize that negative skewness may not be as easy to ride out and recover from as volatility. Changing the start date to 1960, emerging markets have outperformed developed markets. But looking at 25-year rolling periods from 1900 to 2020, emerging markets have only beat developed markets 42% of the time. The multi-factor structure of expected returns that exists in developed markets also seems to be present in emerging markets. Emerging markets factor premiums have been substantial and have shown up in the recent period where they've been largely absent in developed markets. Value is a good example, that is, stocks with low prices relative to their business fundamentals, like book value. Typically, they outperform, but in the US, for the 20 years ending December 2021, value stocks have trailed the market by a painful 1.69% per year, leading many people to claim that value is dead. Meanwhile, over the same period, emerging markets value has beaten the emerging markets index by 1.91% per year and beaten the US market by 2.77% per year. Other factor premiums like company size and profitability have also been positive in emerging markets. Emerging markets are volatile, but they offer diversification to developed markets portfolios. They also have high expected returns, but some of those high expected returns come at the cost of negative skewness, which can really hurt even if you do have a long time horizon. Factor premiums exist in emerging markets and have historically shown up at different times than US and developed market premiums. The last thing to consider is costs. Comparing the iShares Core MSCI Emerging Markets IMI Index ETF XEC with the iShares Core MSCI EFI IMI Index ETF XEF, which is a developed markets index, the management fee and trading expense add roughly 5 basis points for emerging markets. That's not too bad, but the bigger issue is foreign withholding tax. When a stock in a country pays a dividend to a foreign investor, the source country will often withhold some tax. This withholding tax is typically recoverable in a taxable investment account for a Canadian investor because it can be used as a credit against Canadian taxes owing. But in a registered account, like an RSP or a TFSA, the foreign withholding tax is not recoverable. There are a couple of issues here. Emerging market stocks tend to have higher yields than developed market stocks. This means that more of your returns come in the form of foreign dividend income. That alone increases the cost of ownership in both taxable accounts due to taxes on foreign dividends, which are fully taxable, and in non-taxable accounts due to unrecoverable foreign withholding tax. On top of that, the withholding tax rate from emerging markets countries tends to be higher. The result is generally higher income tax and withholding tax costs for emerging market stocks. But it actually gets worse. If you own a Canadian listed ETF that owns a US listed ETF of emerging market stocks, rather than owning the underlying stocks directly, you get hit with a second layer of foreign withholding tax. In Canada, there are no Canadian domiciled emerging markets index funds targeting large, mid, and small caps that hold securities directly. XEC from iShares and VEE from Vanguard both hold their US listed equivalent. For example, the total unrecoverable foreign withholding tax cost for owning XEF, which holds developed market stocks directly in a taxable account, can be estimated at 0%, since foreign taxes are recouped if they can offset Canadian taxes. While XEC, which holds a US listed ETF of emerging market stocks, gives up more than 0.3% on the layer of withholding tax paid from foreign companies to the US listed ETF. In a TFSA account, the difference is even bigger, with XEF losing a little more than 0.2% and XEC losing more than 0.7%. These additional fees and costs add up and they weigh on the expected returns of this asset class. One way around the withholding tax issue is to own an ETF like ZEM, which generally holds stocks directly but does not include small cap stocks. The trade-off here is between giving up higher expected returns on smaller companies for lower withholding tax burden. The dimensional funds that my firm, PWL Capital, uses in client accounts also hold emerging market stocks directly. Some additional costs are not an issue if we expect emerging markets to deliver a large premium over developed markets. But as we've seen, that's not a sure thing, especially if the deep left tail decides to show up in your investment lifetime. I don't think it's sensible to run a portfolio optimization process based on things like expected returns, covariances, and co-skewness to find the theoretically optimal allocation to emerging markets. The output of that type of optimizer is highly sensitive to its inputs, and we only have past or expected inputs. There's a good chance that the future will look different, and our theoretical optimal portfolio will be suboptimal. A quick final point is that not all index providers have the same definition of emerging markets. This is important because mixing and matching investment products from different providers can lead to problems. The most significant example is South Korea, which is the second largest emerging market by market capitalization after China if you follow MSCI's indexes. But FTSE Russell classifies it as developed. This means that if you buy a developed markets product tracking an MSCI index and an emerging markets product tracking a FTSE index, you will have excluded South Korea entirely. The other example is Poland, which MSCI classifies as emerging and FTSE classifies as developed. Applying some common sense, I think emerging markets deserve a place in a well-diversified portfolio, but I would be cautious applying an aggressive overweight to this asset class in pursuit of higher expected returns. The free float capitalization weights that most index providers use are probably a sensible starting point. If possible, seeking exposure to multiple risk factors in emerging markets makes sense. Fortunately for investors, ETFs from Dimensional Fund Advisors and Avantis are now offering these exposures in low-fee products. Thanks for watching. I'm Ben Felix, Portfolio Manager at PWL Capital. If you enjoyed this video, please share it with someone who you think could benefit from the information. We also discussed this topic in episode 191 of the Rational Reminder podcast, and I would love it if you checked it out.